Part 4, Crypto Research Report 2020. Discount rate $1 today is worth more than $1 a year from now. Stock valuation models, such as the discounted cash flow model, can use discounts rates of 1,050% per year based on the risk of the industry and the company. Take the future current value and discount it back to the present. Taking the value of $7.45 and discounting it back 10 years at a rate of 40% yields a rational market value of 26 cents. The calculation is $7.45 per 1.40. An alternative approach is to discount each period utility value and use the weighted average by applying larger weights to periods that are closer. The Satis report argues that discounting isn't required for the TAM analysis 63, however, most reports incorporate a discount rate. Chris Bernanke uses rates between 30% and 40.64. The 2015 Wedbush Securities Report uses a discount rate of 40.65. In this report, we apply 30%, however, additional research on the property discount rate of each coin to reflect distinct risk profiles is needed. Winner-take-all. Since this analysis is investigating 5 coins instead of just one, an additional assumption is required. Many of the coins in the top 5 are competing with each other to become global ledgers for storing and trading digital assets. Therefore, one assumption to make is whether or not there will be a winner-take-all or an oligopoly of cryptoassets for each main use case. Several studies assume each protocol is an isolated economy to simplify calculations. However, the cryptocurrency market is one of the most competitive markets in the world. The cryptocurrency market has less regulatory barriers to entry and switching costs between cryptocurrencies are low. This assumption is relevant for adoption rate, scenario probability, and discount rate. One could argue that the winning protocols of these digital resources will become global standards, and global standards are typically winner-takes-most scenarios. It's the single best hedge against traditional financial infrastructure. Whether you support the fiscal and monetary policy or not, it doesn't matter. This is the schmuck insurance you have under your mattress. Chamath Palihapitiya, founder and CEO, Social Capital 2019. Therefore, this report makes the following assumptions: Bitcoin will beat Ethereum, Bitcoin Cash, and Litecoin in the currency coin group. This is reflected in the discount rate. Bitcoin is assumed to have a discount rate of 30%, while Bitcoin Cash and Litecoin are assumed to have a discount rate of 50%. Ethereum will beat Stellar in the utility coin group. This is reflected in the discount rate. Ethereum is assumed to have a discount rate of 30%. Stellar is assumed to have a discount rate of 50%. These assumptions are based on current technology and regulatory strengths that Bitcoin and Ethereum have. The hash rate dedicated to Bitcoin is magnitudes larger than any other cryptocurrency. Finally, Bitcoin's decentralized nature has prompted SEC officials to unofficially consider Bitcoin to not be a security. This provides some regulatory protection for Bitcoin that may hinder new blockchain startups. However, Bitcoin Cash and Litecoin also have advantages. Both coins offer faster confirmation times and lower transaction fees compared to Bitcoin, and they are sufficiently decentralized with large networks of investors, and Bitcoin Cash has many developers working on protocol upgrades. Instead of a winner-takes-all during the next 10 years, an oligopoly of payment coins is likely to remain in place. Plus, several investors use naive 1N strategies to invest in cryptocurrencies and, therefore, invest equally in the top currency coins in order to reduce risk and capture the market. Valuation results. Looking into all the variables and addressable markets, we have come up with a utility price estimate for each of the examined cryptocurrencies. It is worth noting that each of those estimates is done on a non-discounted basis and with either bearish or moderate market penetration assumptions. The equation of exchange model is an absolute approach to valuing crypto assets, the report begins. This means that the model gives a target price that crypto assets should be priced at based on assumptions regarding changes in supply and demand. Noting that the absolute valuation approach is inspired by Mill's equation of exchange, later formulated by Irving Fisher, the CRR team detailed, in this model, the percentage of the total addressable market (TAM) can be used to estimate a crypto asset's implied future price. After examining all the variables and addressable markets, the CRR researchers arrived at future price estimates for BTC, ETH, LTC, BCH, and XLM. They expect the price of Bitcoin to rise to $19,044 in 2020, $341,000 in 2025, and $397,727 in 2030. Ethereum's price is expected to reach $331, $3,549, and $3,644 respectively, while Bitcoin Cash's price should climb to $414, $6,690, and $13,016 during the same time periods. There is Table 4 equation of exchange forecast of crypto asset prices. Non-discounted utility price predictions. Bitcoin current price is $11,717. Price forecast to the end of 2020 year will be $20,000, 2025 will be $341,000, 2030 will be $397,000 and 2033 will be $395,000. Ethereum current price is $383. Price forecast to the end of 2020 year will be $900, 2025 will be $4,000, 2030 will be $4,500 and 2033 will be $4,000. Litecoin current price is $61. Price forecast to the end of 2020 year will be $80, 2025 will be $1,216, 2030 will be $2,252 and 2033 will be $2,299. Bitcoin Cash current price is $318. Price forecast to the end of 2020 year will be $414, 2025 will be $6,690, 2030 will be $13,016 and 2033 will be $12,941. Stellar current price is $0.1062760. Price forecast to the end of 2020 year will be 20 cents. 2025 will be $2.40. 2030 will be $7.81 and 2033 will be $8.26. It is worth noting that, as of the time of writing this report, the total crypto market cap, all currencies, not just the 5 listed above, sits at $256 billion. In the meantime, the TAM of all the potential markets as discussed above, is in excess of $188 trillion, which makes the current crypto penetration across those markets 0.136%. As seen by the charts above, we believe that Bitcoin is still at the very start of its adoption curve. The price of $7,200 at the end of 2019 suggests that Bitcoin has penetrated less than 0.44% of its total addressable markets. If this penetration manages to reach 10%, its non-discounted utility price should reach nearly $400,000. We should be happier to have a job than to have our savings protected. Christine Lagarde, president of the European Central Bank and former head of the IMF, 2019 critique of the equation of exchange model. The theory of velocity presented in the equation of exchange model that is commonly applied to crypto assets would question the business model of utility coins and payment. Coins that have no incentives to hoard via staking and are expected to have a high velocity as people spend the coins frequently. In support of this theory and Buterin and Samani's analysis, Coin Metrics State of the Network number 37 showed how Bitcoin's on-chain velocity has been steadily decreasing and the price has been going up. The dollars that you work hard for are always buying less and less, yet the government tells you there's not enough inflation. The Fed is a government-created monopoly that counterfeits dollars by the trillions, and you're supposed to believe that this is capitalism. Ron Paul, former U.S. congressman and presidential candidate. However, we also calculated Bitcoin's off-chain transaction velocity and found the opposite pattern. We found that Bitcoin's price and Bitcoin's exchange activity both went up at the same time over the past few years. On-chain velocity is the velocity generated solely by transactions on the blockchain, whereas off-chain velocity is the velocity generated by trading activities on cryptocurrency exchanges. We wanted to check these results with other coins, so we calculated on-chain and off-chain velocity for Ethereum, Bitcoin Cash, Litecoin, and Stellar in order to see if coins were trading hands more frequently on-chain, inter-exchange and off-exchange, or off-chain, intra-exchange. We found that for almost all coins, on-chain velocity is decreasing, while off-chain velocity is increasing. We interpret this to mean that growth in the number of speculative transactions on exchanges is faster than growth of utility transactions to buy goods and services. The key value proposition of blockchain is minimizing the cost of trust down to almost zero. The cost of trust is roughly 35% of global GDP or $28 trillion. Therefore, the target addressable market for blockchain is $28 trillion. Lasse Klausen, founder 1KX, May 2020. It is interesting to observe similar trends in velocity among almost all of the cryptocurrencies. Higher velocities before the cryptocurrency matures and more stable and lower velocities later on. Stellar seems to be an exception to this rule, mainly looking at the huge jump in velocity late 2019, but as we know, Stellar's Coinbase is heavily centralized and it is likely that this is a foundation transaction distorting the numbers. It is also worth noting the huge jump in off-chain velocities among all cryptocurrencies in 2019-2020 coinciding with the drop in on-chain velocity. This suggests that traders who operate exclusively on exchanges and trade with high volumes are becoming the dominant force in the crypto asset market instead of long-term holders. The results that we found do contradict Buterin and Samani's theory because we found that velocity is increasing and the price is going up, even though their model says the price should be going down. Scott Laughlin's critic of their work may hold the answer. As Laughlin points out, applying Fisher's MV equals PT equation of exchange directly to crypto assets doesn't work because of two main reasons. The inverse of average token velocity is not average holding time. For example, let us postulate a money supply of 10 tokens in an economy with a velocity of 10 times per day. If 9 of the tokens are traded once every 1,000 days, and one of the tokens 99.991 times a day, this gives mean token velocity 10 times per day. However, the average holding time for a coin in this ecosystem is 900.001 days, not 1/10 day per transaction. Similarly, while Fisher's equation of exchange is an equilibrium model, which I suppose could be called steady state, it does not depend on the number of users. Laughlin does a few transformations to the equation and argues that user adoption really does matter for the price of a coin. As more people come to the network and demand the coin, the price goes up. Laughlin's critique is straightforward. If more people demand Bitcoin and Ethereum for buying coffees or for speculating, the result is similar. Either way, people are trading economic resources for cryptocurrencies and bidding up their prices. In defense of Buterin and Samani, speculation on financial assets is normally left out of GDP metrics. Foreign exchange volume isn't included in GDP, for example, and therefore, analyzing the velocity of crypto asset speculation may not be appropriate. Final word. Vitalik's token economic concepts of velocity and velocity sinks that encourage hoarding are important, however, the analysis is static and doesn't consider new user adoption and growing demand. If cryptocurrencies gain adoption for long-term hoarding purposes or for short-term spending on speculation or coffees, the price of crypto assets will go up. High velocity on-chain and low velocity off-chain suggests that crypto assets are becoming increasingly used for speculation and not for store of value. Tether or not to Tether. In April 2019, Bitfinex's general counsel Stuart Hoegner admitted in court documents that Tether was only 74% backed by cash and cash equivalents, lending credence to the theory that Tethers are increasingly being minted out of thin air. Bitfinex is being investigated by the Office of the New York Attorney General. He made that claim when there was only $2.8 billion worth of Tether in circulation. Now, there are 3 times that amount. Amy Castor. Key takeaways. Originally, the USD-pegged Tether stablecoin was thought to be an on-ramp into Bitcoin. However, today that is only a small use case. Instead, Tether is used as a settlement vehicle for trading strategies, arbitraging between cryptocurrency exchanges, and for circumventing capital controls. This trend can be referred to as the dollarization of public blockchains. The trend of hyper-crypto-dollarization is expected to increase the demand for Tether and other fiat-pegged stablecoins. Since January, $4.7 billion USD worth of Tethers have been created. Now, there are nearly $9 billion USD worth of Tethers in circulation. Tether isn't fully backed, and there is evidence that unbacked Tethers support artificial price movements in Bitcoin. Bitfinex loans to miners may also be artificially supporting the price of Bitcoin. In September 2018, US Tether USDT reached a temporary high in market capitalization of just over $2.8 billion. By mid-November, market capitalization then dropped to below $2 billion. This correction was followed by a fall in the price of Bitcoin to almost $3,000 per Bitcoin shortly before the end of the year. Today, the price of Bitcoin is once again higher, and the market capitalization of Tether has also risen continuously since then to over $8 billion. Not only has the outstanding amount of Tether hardly ever fallen, not even temporarily, but the issuance rate of new Tether has also shown sudden, erratic increases since the beginning of this year, a total of 3 in number, each greater than the previous one. As one of the big black boxes of the crypto world, many secrets and speculations surround Tether, further fueled by these abrupt growth spurts in market capitalization. Aside from the rumors and speculation, USDT is still regarded as a so-called on-ramp for investors to easily and quickly invest in Bitcoin. It's a fact that Tether has been used as a gateway into the Bitcoin world. However, if Tether was an on and off ramp, then the market capitalization of Tether would in theory have to fall every now and then, because USDT would have to be burnt at intervals by the Tether treasury when holders cash back out into fiat or go into Bitcoin. Since the market capitalization of Tether has risen steadily over the past 18 months without significantly falling even once, this suggests that Tether is essentially not acting as both on and off ramps. New York does not like $USDT as it competes with their upcoming $22 trillion IEO to pay off U.S. debt. Simon Dixon Tether has a real-world use case. Chinese importers of cheap goods in Russia use it to send millions home daily. Anna Baydakova in September 2018, U.S. Tether, USDT, reached a temporary high in market capitalization of just over $2.8 billion. By mid-November, market capitalization then dropped to below $2 billion. This correction was followed by a fall in the price of Bitcoin to almost $3,000 per Bitcoin shortly before the end of the year. Today, the price of Bitcoin is once again higher, and the market capitalization of Tether has also risen continuously since then to over $8 billion. Not only has the outstanding amount of Tether hardly ever fallen, not even temporarily, but the issuance rate of new Tether has also shown sudden, erratic increases since the beginning of this year, a total of 3 in number, each greater than the previous one. As one of the big black boxes of the crypto world, many secrets and speculations surround Tether, further fueled by these abrupt growth spurts in market capitalization. Aside from the rumors and speculation, USDT is still regarded as a so-called on-ramp for investors to easily and quickly invest in Bitcoin. It's a fact that Tether has been used as a gateway into the Bitcoin world. However, if Tether was an on and off ramp, then the market capitalization of Tether would in theory have to fall every now and then, because USDT would have to be burnt at intervals by the Tether treasury when holders cash back out into fiat or go into Bitcoin. Since the market capitalization of Tether has risen steadily over the past 18 months without significantly falling even once, this suggests that Tether is essentially not acting as both on and off ramps. The argument against this is that the demand for Bitcoin is very volatile. During the last 2 years, there have been repeated periods when Bitcoin's price fell, while Tether's market cap remained the same or even went up. If USDT were used primarily as an on and off ramp, its positive correlation with Bitcoin would have to be much stronger. This isn't the case, especially since there are even indications that the correlation is negative. This leads to the conclusion that something else more serious is afoot. The coming crash of Tether, USDT will cause the crash of Bitcoin as the former was used to manipulate the latter. Nouriel Roubini alternative explanation sought. For example, some market observers suspect that USDT is being created without collateralization. So, Tether would be created specifically by Tether Limited and its parent company Bitfinex and held in fractional reserves in order to drive up the Bitcoin price, so the argument goes. This way the critics argue that Bitfinex is trying to generate excitement among retail investors, which would then turn into a hysteria of FOMO leading up to a new Bitcoin bull run. This is how some analysts explain the fact that on May 14, a few days after the Bitcoin halving, the Tether market capitalization suddenly rose from just over $6 billion to almost $9 billion. What sounds like a conspiracy theory to some, others consider to be a fact. After all, the two companies Bitfinex and Tether Limited would have strong incentives to run such games. As the New York Secretary of Justice pointed out, only about 70% of outstanding Tether is secured by cash and cash equivalents. 66 This hole when it comes to collateralization, according to the skeptics of Tether, could of course be filled up step by step if Bitcoin stabilizes at a higher level supported by private investors. The collateralization that Bitfinex partly holds in Bitcoin as well would then have more value that could be sold for dollars and improve the reserve ratio.